Today I want to analyze Mondelez, one of the largest food companies in the world. Here we can see some products that they own. I think the most popular brand is probably Oreos, Milka and Toblerone. If we take a look at the stock price, we can see in the last 5 years we are up 30%, so a decent performance. If we take a look from 2023, we are down around 14%. So overall, I think this is an interesting company. We're gonna take a look at the financials to find out if this is a good buy right now. The first thing we can recognize is the huge market cap of 87 billion US dollar. This makes Mondelez the fourth largest food company in the world by the market capitalization. We also have a dividend yield of around 2.79%, which we can see here did grow in a good rate in the last years. So it's something we like to see as well. Now we're going to take a look at the financials. The first thing you're looking for is revenue growth in the last 5 years. We want to invest in a growing business and not a declining business. So we can see here in 2020, the revenue was around 26.5 billion US dollar. This was 2.7% increase from 2019. Then we had the 8% growth in 2021. This is a good growth, I would say. Then in 2022, around 9.6% growth. This is also very good. 2023, around 14% growth. This is very good, I would say. And then in 2024, we had around 1% growth. So I think in the last 5 years, we had a good growth. So it's a check here. The next thing you're looking for is free cash flow growth in the last 5 years. The free cash flow is very important because it can be used to pay the dividend, to pay the stock buybacks, to invest in the business, and also to pay back the debt. So in 2020, the free cash flow was around 3.1 billion US dollar. This was a 2% increase from 2019. Then in 2021, we had around 2.4% increase. Then in 2022, we had a decline around 5%. This is something we don't like to see. But then in 2023, we had a strong growth around 20%. This is very good. Then in 2024, we had a 2% decline again. So overall, I think we had some good growth in the last 5 years. Of course, we don't like to see the decline in the free cash flow, but it's still a check here for me. If we take a look at the operating cash flow, we can see in 2024 we had around 4% increase in the operating cash flow. This is something we like to see. And if we take a look at the free cash flow, we had a 2% decline. So the reason that the free cash flow declined is mainly because the capital expenditures increased in 2024 around 200 million US dollar. So this means a company investing more money into the business. The next thing looking for is a free cash flow yield over 4%. So this can also tell us about the valuation of this company. The higher the free cash flow yield, the higher the indication for undervaluation. So we're going to take the free cash flow from 2024. This is around 3.52 billion. We're going to divide it with the current market capitalization, 87 billion. And then we're going to get the free cash flow yield for 2024. So the number we get is around 4.04%. So this is a check here, it's over 4%, but for me this looks more fair valued and not extremely undervalued in my opinion. I think we should also make some assumptions about the free cash flow in the future. If we ask ChatGPT, we can see here in 2025 the free cash flow could be around 3.5 billion US dollar, in 2026 around 4.1 billion US dollar, and in 2027 around 4.8 billion US dollar. So I think we should assume maybe in 2027 we can reach a free cash flow of around 4.5 billion US dollar. So if we divide it then with the current market capitalization of 87 billion, we would get a free cash flow assumptions for 2027. So the number we would get would be around 5.17%. So this number would look already better. So it would be more higher indication for undervaluation in my opinion. So it's something we like to see. The next thing you're looking for is the debt to free cash flow ratio under 5. So this means the company can pay back the debt with the free cash flow in under 5 years. A very important number to me because if a company has too much debt and cannot repay the debt, it can risk to go bankrupt. So what we're going to do now, we're going to take a look at the long-term debt first. So the long-term debt is around 15.5 billion. We're going to add the short-term debt as well. So we can see here the short-term debt is around 1.95 billion. Then we're going to divide it with the current free cash flow. Current free cash flow around 3.52 billion. And then we're going to get the ratio that we're looking for. So the number we get is around 4.95. So this means a little bit under 5 years we can repay the debt with a free cash flow. So it would be a check here. Is under 5. This is something we like to see. We can also take a look on the cash on hand, how much money this company has in the bank. So this is around 1.35 billion. I think this is a good amount as well. Of course, it's a huge company, and we can see as well the cash on hand did decrease in the last 3 years. So overall, I think it's still a good balance sheet in my opinion. The next thing you're looking for is the enterprise valuation to free cash flow ratio under 25. So this can also tell us about the valuation of this company. The lower the number gets, the higher the indication for undervaluation. So what we're going to do now, we're going to calculate the enterprise valuation first. So this is the current market capitalization, 87 billion. We're going to add the debt. So the debt is around 17.5. Then we're going to take minus the cash that we had. This is around 1.35 billion. So then we're going to get the enterprise valuation first. So the enterprise valuation for this company is around 103.15 billion. So this is how much the company is worth in total. Then we're going to divide it with the current free cash flow. This is around 3.52. So then we're going to get a number around 29.3. So this number is higher than 25. So this is something we don't like to see. It's not a check here. And for me, it's an indication for overvaluation. We can also calculate the ratio for 2027 with the free cash flow assumption of 4.5 billion US dollar. Then we would get the ratio of around 22.92. So this would be under 25, so it would be a check, but still we don't know for sure how much the free cash flow can grow. And I think this company doesn't look extremely undervalued right now to me. The next thing we're looking for is shares outstanding decrease. This means the company buys back their own shares. So we like to see that, especially if we think the company is undervalued. So we can see here Mondelez did buy back a lot of their shares many years in a row. Since 2013 actually, around 2%, and 2015 around 5%. So they buy back a lot of shares. In 2024 it was around 1.4%. So this is a good numbers. I think this is something we like to see, but of course this company not has the best balance sheet. It means they quite have a lot of debt, I would say, but I think they can still afford the buybacks right now. I would like to give my conclusion about this company, so let's start with the positive. So I think we had a good revenue growth in the last 5 years. I also think we had a good free cash flow growth as well. So I think we have a decent balance sheet. So we not have too high debt, but also not too low debt. So it's around decent. And also the cash on hand is okay, but also not great in my opinion. The free cash flow yield is also decent, around 4.04%. For me, it's not an indication for undervaluation right now. I think we have a high enterprise valuation to free cash flow ratio around 29.3. So for me, this company is not a buy right now. I would say is around hold. If you found this video helpful, don't forget to like and comment and subscribe for more content.